Well, hello, everybody. It's so pleasant to be here. I'm really glad to join you all here today. And as Jeremy said, we've been kind of doing a Mutt and Jeff show here for a while. I'm not sure who's Mutt, who's Jeff, but we do this a lot, go around the state and do these presentations, and we're really happy to be doing that here in Topeka. Many of you may know that every year I do an annual housing forecast for all of the metropolitan areas across the state, including Wichita, Topeka, Lawrence, Manhattan, and Kansas City, and the state as a whole. And we put that out every October about the same time that Jeremy does their big employment forecast. We have this beautiful publication that, quite frankly, I'm out of copies of, but it's made possible because of contributions, because of Capital Federal and Security First Title here in Topeka. And so we're very, very grateful for their contributions to make this possible. If you want to get copies of our forecast publication, check with the Sunflower Association of Realtors just down on Burlingham Road. They had the last copies that I know of. So I think they still have some and you can pick them up. Or you can visit our website. And our website is realestate.wichita.edu. And right there on the homepage, you'll see a link for the housing forecast where you can get copies of our forecasts for the entire state. And you also can download my presentation from today. So if you want my slides, that's available there as well. And I'd be remiss if I didn't mention that we are able to do this because of a partnership that we have at Wichita State with the Kansas Association of Realtors and all the realtor boards across the state, including the Sunflower Realtors, where we access the monthly MLS statistics, and then we prepare monthly statistical reports so that they have them, and then that gives us access to be able to do our annual housing forecast. So when I do the forecast, I always start by looking at two fundamental foundational elements. One is the labor market, and Jeremy's talked about that, so I won't talk about that here today. But the second is the mortgage market. So do people have jobs, and can people finance the homes that they want to buy? And the short answer with the labor market seems to be yes, they've got jobs. If they want jobs right now, they should have them, and they should be having increasing wages. That's the general picture that we have. Mortgage rates has been an interesting story. We are still in an era where mortgage rates are incredibly low. Now, the Mortgage Bankers Association, we've seen some things that have moved here just in the last few weeks. And the Mortgage Bankers Association, however, forecasts the 30-year fixed mortgage rate. And as of last week when I put this together, their latest forecast is for the 30-year fixed mortgage rate to still be right around 4.5% by the end of 2023. And so that's an incredibly low mortgage rate. Now, some people have really gotten, starting to pull what limited hair we have in our heads left and pull it out and being fearful of, oh my goodness, look at how those mortgage rates have spiked. 30-year fixed mortgage rate over the last 4 weeks has increased over 50 basis points or 0.5%. And that's a very sharp, fast increase. But it needs to be kept in perspective with where we are compared to normal mortgage rates. And in my view, a normal mortgage rate where we have nothing special going on in financial markets, nothing's weird going on in financial markets, we have low inflation with solid economic growth, we ought to see mortgage rates in the range of 4.5% to say 7%. That would be consistent with solid economic growth, low inflation, and again, nothing unusual in financial markets. So at the top end here, where the Mortgage Bankers Association is forecasting for not just this year, but next year, we will be at the very bottom edge of what I think might be considered normal. And we're still, 100 basis points lower than that right now. So what's driving this? Well, ever since the financial crisis, we have been in a world where financial markets still have not returned to normal. And you may all remember the talk of quantitative easing and the extraordinary actions that the Federal Reserve took to try and stimulate the economy in the wake of 2007, 2008, and ongoing. One of those extraordinary actions was to purchase mortgage-backed securities. Those are when you and I borrow money for a house, very often the lender will sell it to someone on the secondary market who takes that loan, matches it up with a whole bunch of other loans, and they securitize it. They create a new bond using our mortgages as collateral. And prior to 2008, the Federal Reserve never played in this market. In the wake of the financial crisis, they jumped in, both to stabilize housing markets and to provide economic stimulus, monetary stimulus. And they ended up topping out just over $1 trillion of mortgage-backed securities. They tailed off for a little bit, and then through 2013 and 14, they increased where they stabilized at about $1.75 trillion worth of mortgage-backed securities. And then you remember all the talk about the taper tantrums, right? And financial markets getting upset because the Fed was easing off the stimulus. And you started to see that, and it was a very gradual process. The Fed's plan has been to not sell mortgage-backed securities, but rather just stop purchasing as many so that when their existing portfolio matures, it rolls off their books and they move their way back in that market. Well, when COVID hit, they doubled down, and we're now sitting at well over $2.5 trillion of mortgage-backed securities that are held on the Federal Reserve's balance sheet. They have announced that they are going to be tapering, but these are daily data, and as of last Thursday, they had not begun yet. And so again, that process, their plan is not to sell these mortgage-backed securities, but rather to simply stop buying as many. So it will be a gradual process for that to move off. As they do that, that will put some slow pressure for mortgage rates to continue to rise. And I think that is already built in to the Mortgage Bankers Association's forecast. The other thing that could impact mortgage rates is inflation and what's happening with inflation. And one thing that I think is a useful way to look at this and think about inflation is to ask, what is your inflation expectations? It's not what happened last year that lenders have to build into the mortgage rate. Instead, it's what they think will happen, not just over next year, but over the next 5-7 years, because that's a typical whole life that someone might hold a mortgage. Now, we all know that the inflation rate really skyrocketed towards the end of this year, just under 7% CPI inflation through the end of December. The blue line on this chart is the University of Michigan's survey of households, where they ask people, what do you think inflation will be over the next year? And typically that actually follows very closely to actual headline inflation, although it has trailed it somewhat as inflation has bumped up. But the last line on here is a very interesting one, and it's called the 5-year break-even rate. And what is done here, you may not be aware, there is a security out there called a TIPS security. Has anybody ever heard of this security? Treasury Inflation Protected Security. And what happens with this is it's just like a regular Treasury security that you would buy, but at the end of the year, they go back and they ask, how much inflation did we have last year? Oh, 5-7% inflation last year? We're going to increase the principal balance of your security by that much to compensate you for the loss of purchasing power due to that inflation. And then the new interest is based off of that higher principal balance. They do the same thing the next year, and the next year, and the next year. So we have the traditional Treasury security that your purchasing power is eroded by inflation, and then you have the TIPS security where it's protected. The difference in interest rates between those two, we can tease out implicitly what financial markets believe inflation will be, in this case, over the next 5 years. And what you can see from this is that this 5-year break-even rate, the orange line, has financial markets expecting that on average, over the next 5 years, CPI inflation will be just under 2.5%. Now that, to me, doesn't guarantee that financial markets are right, but it's a lot of people putting their money down, betting on this, kind of like people do the Vegas line with the Chiefs game over the weekend. And you may think you're smarter than financial markets, but on average, if you beat them on average, it's only due to luck. It's not because you're really smart. And so this is always my go-to of saying, what do we think is going to happen? That number's gone up a lot over the last 6 months. You'll notice that in the middle of 2020 even, it was back down around 1.5%, down around 1%. And then at the beginning of 2021, it was around 2%. It's now up over 2.5%. But still, that's a lot lower, which seems to suggest transitory inflation. So, with all of that, what's been happening in housing markets? Home sales activity has been nuts. You all have heard the stories. Everything has been great. This is the actual home sales in the Topeka area on a monthly basis over the last several years. That's what the turquoise bars are. And the maroon line is the moving average, which gives you a sense of getting away from the seasonality where sales go up in the spring and tail off in the fall. And sales increased pretty dramatically through the first part of the year, and then they leveled off a little bit through the end of the year. Our original forecast for the end of 2020 was that home sales in the Topeka area would end the year up a little over 1%. Actual sales ended a little bit lower than we thought, only 3,496 sales for last year, which is just less than a 1% increase. We've not revised our forecast for 2022, and so that means that this percentage increase looks a little bigger than what we originally forecast. But essentially what we're saying is it's a very modest increase in home sales. And the reason for this is demand continues to be strong, but we're seeing very, very tight inventories, which is limiting how realtors are able to sell. We could sell more homes if there were more homes on the market. So I mentioned that the thing that's constraining home sales, it's not demand. Demand is incredibly strong. What's limiting home sales activity is the inventory of homes available for sale. We measure housing market balance through a number that we call months supply. What we do is we take the number of homes that are listed on the market and we compare that with the average pace of sales over the prior year. So if you've got, say, 1,000 homes on the market, and on average you're selling 200 homes a month, then 1,000 divided by 200, you have a 5-month supply of inventory. In principle, it would take you 5 months to work through that inventory. We normally think of a balanced market is having between a 4 and 6 month supply of homes available for sale. Now you can look on this chart and you can see that in Topeka, which is the very bottom line, if you can't tell the difference of the colors, we've not been a balanced market, that 4-month supply, since the end of 2015. I had somebody talking to me earlier and asking about, where did all this come from and how did all this come out so fast? And my answer is, it hasn't. This has been building for about 12 or 13 years over a long period of time as we've had home sales continue to rise without having enough new inventory being added to the market to offset that. Right now in the Topeka area, there is less than a 1-month supply available for sale before we enter into the spring selling season. Now we expect that will increase just a little bit through some normal seasonality, but this is incredibly tight. It's tighter than it's as tight as we were a year ago at this time. And so we don't think we're going to see anything that's a lot easier this year than it was last year. By the way, one thing that has changed over the last couple of years, it used to be the case that you looked at modestly priced homes and they were always much tighter. We've been in a really tight inventory with modestly priced homes for a long time. but higher priced homes, which I picked an arbitrary point of 400,000. You can pick your measure of the upper end of the market. Usually, the upper end of the market is much more flush. It takes a lot longer to sell homes, and there's more inventory. Over the past year, even the upper end of the market has really tightened up. And so when you see every aspect of the market really tight, that means that home prices are going to appreciate. Our original forecast was for an 8.3% increase for the end of last year and another 4.5% this year. We don't have the fourth quarter numbers yet, but since we released this, the third quarter numbers were released for Topeka. Through the end of the third quarter in 2021, Topeka metropolitan area home prices increased 15.8%. And that's a constant quality index. That's the same home selling. If it sold 1 year and sold a year later, incredibly fast. Jeremy had down on his list, could home prices drop? My answer to that is absolutely not. The worst case scenario for home prices is that the home price appreciation will stagnate, but we will not see these new high levels you're seeing. Get used to them. I think that we could likely see even stronger appreciation in 2022 than what we originally forecast, and it will take several years for us to get back down to more normal rates of appreciation. And the reason ultimately is because new home construction activity has not been keeping pace with the demand for housing. Our forecast for new home construction, and we don't have the final numbers in yet, was basically for Topeka to be flat this year, the same 380 new single-family permits that we had last year, with just a very modest increase in 2022. One of the challenges is that as we went through the downturn in the wake of the financial crisis, existing home prices were really flat. Construction costs went way up. And so as a result, it got harder and harder and harder for new homes to compete. So most of what's being built are very expensive new homes. Now, there's more incentive to do it because those inventories have gotten tighter in that upper end of the market, but it's going to take a lot of time for new home construction activity to really catch up and resolve our inventory problems. So that's my forecast. Again, you can see the entire forecast on the Center for Real Estate website. And when we're done here, I'm happy to answer questions. But Jeremy just gave me my 1 minute mark. And so I think my time is up. Thanks again to Security First and to Cap Fed for sponsoring our forecast. And thank you, Jeremy, for having me here. You all have a great day.